Hey everybody, welcome to 5 Minutes of Financial Markets. Interesting day today in the market. We started off with a pre-market announcement of the PPI, which came in at 8%, a few ticks below the consensus and the forecast. I mean, this is still a crazy high inflation number, but considering what we've been seeing, this was a welcome relief for the market, especially after last week's CPI that, kind of gives people the feeling that inflation has peaked, maybe inflation is easing, and that can pave the way for a Fed pivot. And as we all know, that's the only thing driving the market right now is what is the Fed doing. I think we still have a long way to go. The path is likely not straight down. I mean, the Fed target is 2% for inflation. We're not going to get there anytime soon, believe me. So the market gapped higher at the open. Let's go to the 1-minute chart on the SPY. So looking at yesterday's close here, gapped up to over 400. Blue line here is the market open. I'm on Pacific time, so it opens at 6:30 here, closes at 1 p.m. You see we just kind of chopped around at that 400 to 402-ish level. And then right around here, 10:15, we got news of Russian missiles hitting Poland, which obviously is a NATO member. That could domino into who knows what. So that spooked the market a little bit. We had quite a sell-off, found support down at 395, and then started to, sort of chop back up, gradually up. Interestingly, this 399.33, that was the high from last week, served as support throughout the first half of the day, and then we broke through on the Russian news, and then served as resistance for the second half of the day. I like to keep those weekly high and low lines on my charts, and the daily highs and lows for the last several days. You can see a lot of potential support and resistance, especially when they converge with moving averages. So speaking of, let's look at the daily chart on the SPY. We've got this trend line at the top going all the way back to January that's been the big resistance trend line. Every time we sort of rally up, we hit this line, sell off, particularly back here in August where we hit the trend line and the 200-day moving average at the same time and then had this wicked sell-off back down to the bottom. Got a couple different potential trend lines of support here, but what I want to focus on is what we've done since this really bad CPI number in October, bad relative to expectations. Now, we've stayed in this upward parallel channel, mostly on the top half. You can see here last Thursday when the recent CPI number came in, which, it was 7.7%, which by historical standards is crazy high. But compared to what we've seen for the last 8 months, it was a very nice low 7.7%. And so the market gapped higher on that and just ripped up to the top of this channel and has been bouncing off that ever since. I really think we have room to run here. I think we could peak out around 408, 410. There's nothing really on the calendar as far as news events. Now, obviously, Russian missiles weren't on the calendar either, so you never know what can pop up. But we don't have any scheduled news releases other than we've got the Fed meeting, the Fed minutes coming out on Wednesday the 23rd. Happy Thanksgiving. We've got the next jobs report December 2nd, and then we've got back-to-back CPI on December 13th, followed by the FOMC rate hike on the 14th. Right now it's looking like about a 50 basis point hike, but we'll see. But between now and then, I mean, there's nothing to stop this market from running up there until it hits this upper resistance line. 408 to 410, that's where I'm going to start pulling back on some of my long positions, taking profits. But until then, I think it could go. This is a really interesting chart, and you've probably seen this other places. If not, it's a good thing to keep an eye on. These are the divergences between both the S&P and its own momentum down here, or the S&P versus the bond market up here. So SPY is on top, HYG is on the bottom, that's the high yield bonds. They say the bond market has the smarter traders, and that's definitely true. I mean, you think about it, how many retail stock traders are there? There's millions of them. How many retail bond traders are there? Not very many. If you're trading bonds, you're probably doing it for a shop or an institution, and you probably have a lot more market insight and knowledge than the average stock trader. So when you see divergences between the stock market and the bond market, you really need to pay attention. Look back here between November of last year and January, you had this big run up in the S&P. At the same time, the HYG was coming down. That's a big divergence, and look what happened right after that. Big sell-off in the stock market. Here again, Feb to March, you got a higher high on the S&P, lower high on the HYG, and what happens after that? Boom, big sell-off. Same thing here from June to August. Big higher high on the S&P, big lower low on the HYG, and boom, we sell off. So what do we have forming here? Well, we've got clearly a higher high on the S&P. We've got an exactly flat, this like to the penny, got a double top here on the HYG. So not as big or pronounced a divergence as you usually see in these other ones, but definitely something to keep an eye on. Like I said, I think the SPY can run a little further here. I've got this alert set at 408. That's where I'm going to start taking profits, but I would be quick to watch for a trend reversal here because it could happen. Finally, I want to take a look at the VIX. The VIX has been trading in this wedge for the whole year. We dipped below it on the big CPI number last week. Everybody thought, not everybody, but a lot of people were saying the bottom's in and time to run. VIX broke through here, and then today on the Russian news came right back into this channel. But it did close outside of the channel, or sorry, close just above. So this is something to keep an eye on. We probably won't have what we can call a clear bottom until we see a big capitulation event in the VIX. And what I mean by that is, you look back at every major bear market where VIX is elevated, it doesn't end, it doesn't bottom until we see this big blow off top in the VIX where everybody's selling everything, running around with their hair on fire because they think the market's going to zero. And until we see that, I don't think we can declare this bear market over. I think we're going to still see lower lows, even though in the near term I think we're going higher. I think that the October low that we saw back here is not the bottom. I think we're going to see a much lower bottom sometime in 2023, possibly coinciding with a big blow off top in the VIX, and that's when I'll feel comfortable starting to get my long-term investments back in because I'll think that we're near a bottom. All right, that's all I have for today. See you next time.